System initialization sequence complete. Current database year 2050. Accessing the primary archival records for the April 18, 2026 market crash. On that date, the Philippine Stock Exchange Index collapsed below critical psychological support, closing the session at exactly $5,999.13. This dashboard captures the immediate damage. Unrealized losses fractured the portfolio, bleeding past negative 102,000 pesos. The recovery sequence relied on specific internal mechanics. Beneath the surface-level bleed, liquidity extraction protocols were being initialized to keep the system operational. The primary extraction maneuver capitalized on raw market panic. Geopolitical conflicts drove crude prices higher, creating highly volatile momentum in commodities. This chart tracks the execution on Apex mining. Capital was systematically accumulated between 1470 and 16 pesos, then fully liquidated at the localized peak of 1760. That swing trade locked in 12,000 pesos of realized profit, immediately transferring it into a protected cash vault. Free liquidity then rotated into defensive assets like PLDT and heavily discounted consumer staples like Universal Robina. This notice confirms the strategy's active cash flow mechanism. On April 15th, defensive positioning yielded a direct plus dividend payout of 2,763 pesos and 90 centavos. These blue chips act as shock absorbers. Their institutional scale allows them to pass inflation costs down to consumers, generating direct yield that offsets portfolio decay. The system still carried severe vulnerabilities, primarily concentrated in depreciated legacy assets, dragging down overall performance. The GMA network position suffered a 48% drawdown. As the broader economy slowed, corporations slashed advertising budgets, directly choking the network's revenue. Simultaneously, Union Bank absorbed a 33% decline. The asset remains suppressed by the debt and integration frictions stemming from its Citi acquisition. High macroeconomic borrowing rates actively punished capital-intensive plays. This led to a 20,000-share liquidation of Citicorp Energy REIT to rescue trapped capital from a hostile interest rate environment. In a stagflationary environment, slow-growth legacy models and rate-sensitive sectors become extreme structural liabilities. System diagnostic complete. Extrapolating 2026 data to current 2050 survival metrics. The ruthless guarding of cash reserves during peak market panic was the determining factor. Refusing to immediately reinvest created a floor against ruin. Rotating those protected reserves back into institutional yield converted a defensive cash position into a scalable income stream. That transition reset the portfolio's baseline, allowing it to move from survival back into accumulation. The archive confirms the protocol. The disciplined execution of the vault strategy provided the mechanism to survive and overcome a systemic market crash. End of file.